All right, what's up, long gamers and crossroaders? I don't know if you noticed, but we got a little new intro to switch it up for the first time in a while. And this is the first episode in, I don't know, I mean, including the break because of Christmas, like 2 months that it's just been Trayden and I. I hope you guys all got to listen and see the last series on crypto. I think it was by far our best series, by far the most listens, and it's actually really kind of helped build our podcast and our following. So if you haven't, I would definitely recommend going back and checking that one out. But that is not what we're talking about this week. This week, we're going to talk about one of my threads that I actually wrote that has done pretty well. And it's all about 6 things that we think that Dave Ramsey has wrong. So I'll be honest, I grew up in a Christian household. My dad worked at a church. Like, I saw all the Dave Ramsey stuff. And then I even worked at a Christian financial planning firm right out of college. And Dave Ramsey was a lot of what is taught. And I really want to start this out by saying, like, I don't hate Dave Ramsey, and I don't think everything Dave Ramsey does is wrong. But what I think has happened over the years is that Dave Ramsey is really the guy to help people with low income who are in a lot of debt get out of that. Dave Ramsey for that group is actually amazing. Like, if I know somebody in that world, go listen to Dave Ramsey. He can help you get through this and get out of it. Great. But once you get past that point, Dave Ramsey's teachings are really not the best for you. And so that's our audience, are really the people who are beyond that point, starting to make pretty good money, probably don't have a lot of high interest debt, and really want to start to plan for the future. And so we're going to point out 6 different things that we think that Dave has wrong that I don't really think that you should apply to your life.
Yeah. And before we get into it, like, this is the 20th episode, and I can't believe we've already been doing this for 5 months. We missed a couple weeks at the end of December just with holidays and little sickness going around. But yeah, I'm excited for this episode. Like, I did Dave Ramsey reactions in the past a little bit on YouTube. I think I might have took him down just because I didn't really want to build a brand around calling out other people. But
it's like picking the brand for hating Northwest Mutual or something. It's like, you can do it and you could build a brand that way, but also, like, you don't want to be known as the guy that has to only hate on somebody to build your own brand.
Yeah, which isn't what we're going to be talking about today. It'll be more just kind of like saying our views around some of the things that he talks about. And the first one is, like, he says that you don't need a credit score, your credit doesn't matter. And I kind of get why he says that, because he just suggests not to have any debt in general and nothing like that. So it's like, yeah, if you kind of take that approach, credit score might not be that helpful, but it's almost like he projects his own fear of debt and money onto his audience when he gives advice like that. Because I don't know how familiar people are with Dave Ramsey, but he lost his ass in real estate a long time ago, and now he's just super anti-debt, everything like that. And a credit score, in today's world, super important. Applying for, or just getting an apartment, they usually run your credit. Just really anything involving debt, it doesn't have to be bad debt, it could just be getting a car or a mortgage. They're going to run your credit, and the worse credit score you have, the higher interest rate you're going to get, and
you might not get interest. Yeah, or you might not even be able to get the loan. So, I've gone through this renting. I had a roommate who right out of college had no credit, and he couldn't get approved for the apartment. So then he has to go have his mom co-sign it. And, okay, yeah, that's a workaround. That might work. But what if your mom's a Dave Ramsey follower too, and she doesn't believe in credit? And all of a sudden now you can't get the apartment or get the mortgage or the loan for your car. And everybody's like, well, you don't need debt. But also, who can get a mortgage without, or who can buy a house without a mortgage? Not very many young people. Who can buy a car in cash in their 20s and 30s? Not very many people. And I also think, besides the fact that your credit does matter to get all of those things, the other side of this too, which I think is really important, is this came from a debt mindset for people who have been stuck in debt, high interest debt, and can't get out of it. If you're the average person who that isn't your problem, where your debt is a low interest car loan and a mortgage, well, 20 years ago when Dave Ramsey really started, those were really high interest rates, 7, 10, 12%. That's way different than today when borrowing rates are 2 to 3%. It might make sense to leverage debt versus just get rid of all of it. Because in Dave's steps, he really has it that you get rid of every single piece of debt before you even contribute to your 401k minus your mortgage. And then you pay off your whole mortgage. Then you go invest more outside of it, which again, like I don't think you have to have your whole mortgage paid off at 3% before you go invest in a diversified portfolio.
No, especially for young professionals, like in their 20s and 30s, like we're only young once and we can only invest while we're young once. So it's like if we spend 5-10 years paying off debt, that's 5-10 years of compound interest that we're not earning. So it's like finding that balance between like, yeah, you still need to pay down debt, but you still need to invest for the future at the same time. And just paying it all off if it's a low interest rate just really doesn't make sense in the long run.
Yeah. And I think a lot of people, you made a really good point about like time in the market. And we all know the biggest factor is time in the market. And so I think when people think about, the pay off debt or whatever, like if it's high interest debt, of course, but this low interest debt, like it's not as easy as, okay, hey, it's going to take me 10 years to pay off my house. I'm going to have more money available at that period of time to now go catch up. So if I would get $100,000 or $150,000 over 10 years, and I can do that over 5 years, I'm caught up. But you're not caught up because you're not taking into consideration the time in the market, the compounding, what it could grow to be. So it actually takes longer than, hey, I got to catch up to that 150. I have to catch up to whatever that 150 has grown to be, which is definitely harder.
Yeah. And to go back just a little bit, could you elaborate on like the difference between short or bad and kind of like just good interest rates? Like bad debt is 6-8% above that. Like what's your kind of general rule of thumb?
Yeah, I kind of use the rule of thumb as in if this interest is higher than what you would expect to make in the market on average. So obviously, we look at the market, it says 8% or 9% a year. That's an average. So some years it might be down, some years it may be way above it. So kind of what I do is I say like, if it's to me like close to that number. So if it's like 6 and above, I'm going to probably go pay off that debt first. If it's for sure below 5, especially below 4, to me, I would probably just pay that off slowly and invest. That hard number really is like 4.5, 5 to 8. It really is a personal choice what your risk tolerance is. Like if you're going to be in a 50-50 portfolio, then that's different than somebody who can be in a 90-10 and expect a little bit higher of returns. But I do think that's a good question. And I guess this all goes into number 2, because I did make the point that you don't need to pay off all of your debt except for your home before investing. I just really disagree with that. I think it can put you far behind. I think for somebody who's in extreme debt, this could be helpful for them to fully get out of debt and not go backwards. But to me, if some of these people, like I have clients with 2.3% interest, like mortgages, for what reason would we try to pay that off quicker when it's like that's a negative return based on inflation?
Yeah, exactly. Yeah. You really it's really so many things in finance just come down to running the numbers and just see like what logically makes sense. And then like tailoring it a little bit to your personal, like if you have something at like 5%, that's kind of sitting in that middle between it's a little high, but it's not too crazy. If you're just someone who doesn't like having debt, then it makes sense to pay more towards the debt, maybe invest a little bit less just to kind of get that weight off your shoulders. Like the numbers are always there, but then you still have to take into that personal account a little bit, of course.
Yeah. And I think the other thing to note here too is Dave does say that like you shouldn't even do your 401k till you pay off all that high interest debt. And again, like for somebody that is doing pretty well as a decent income, to me, that doesn't make sense. If you make $100,000 a year, 6% match your 401k, if you're just paying off debt and you don't take that 6%, you're leaving $6,000 on the table. Now, even go up people who make 150, 200, 250, 300, like the amount of money that you're leaving on the table doesn't make sense. You might as well at least get to the match, then go pay off that high interest debt at the same time as doing those two. I think that's super important.
Yeah.
Okay, so number 3, mutual funds are not better than ETFs. He says that mutual funds are better than ETFs. I'm going to quote exactly what he says on his website. And we'll just go through one at a time. This first one says, mutual funds are designed to be invested over the long term rather than traded like ETFs. So what he means here is that mutual funds, basically, you sell and buy not during trading hours. It's basically the price at close. And ETFs are traded daily and they move like on stock prices. So what he thinks is that because they're traded like that, you're more likely to buy and sell I don't know if there's any research behind that. Like I truly haven't seen that be a case or a problem for most people. And the biggest thing is that mutual funds typically come with higher fees than ETFs, like honestly, by quite a bit. They also don't shelter gains like ETFs do. So if you're investing in taxable accounts, a lot of gains are going to spit out from mutual funds that wouldn't necessarily with ETFs.
Yeah. And to hit on the fee thing, I wrote a newsletter a couple months ago. It was like fees to watch out for in the financial industry. And I ran numbers on a mutual fund versus like a low cost mutual fund. And there's this first one, it has a 5.75% front load fee. And that just basically means like however much you invest, you have to pay a 5.75% fee to even get into the mutual fund. And then it has an expense ratio of 5%. So kind of like in the first year, you're paying, yeah, it's super high. And it, like, if you're just looking at it, it looks like a good mutual fund. Like it's $8. You could buy a lot of shares of it with not a whole lot of money. But then when you look into the fees, it's like, that's insane. So compared to a Vanguard mutual fund, VT Sachs, this is not financial advice. This is just a very well-known mutual fund. And it only has a 0.04% fee. And so it's about like more than a 9% difference. And just for comparison, like if you had $100,000 invested in both, the first one, the annual fee would come out to like $5,000. And with the one with the lower fee, it would be about $40. So that's almost $5,000 difference that's going to be stayed invested instead of paying fees on it.
I love that example. I will note that like that's probably like the most egregious end of what some mutual funds are. Like the front fee that you talked about, I do see that. So I want people to be aware of it, because like 5.75% like commission to the person for you buying that fund, no fund is worth that I've ever seen. So I will say that. And I did some research and it says that the average mutual fund fee is like 1.31%. This is on fidelity.com. The average ETF is 0.73. So it's 0.73 versus 1.45. So again, that is the average. Our portfolio costs like 0.18. Like, I think it's really important to focus in on lower fees, and mutual funds definitely typically come with higher fees. I just had a client I brought on that from a different firm, and I looked through it and he had all of his ETFs or all of his mutual funds were 0.8 to 1.3 fee. His whole fee to me per year for everything I do will be cheaper than the internal cost of the funds that he was using before. So these are things people don't think about to look for, but it's definitely something to look at. And that was a great example. Next one, he says, ETFs cause you to lose the personal touch that you get in actively managed mutual funds. I don't even know if we actually have to talk about that one. That is the most garbage thing I've ever heard. Personal touch. There's no personal touch that you have to your mutual fund. No. Yeah, and there's still, I mean, you can still have active of either. So I don't know. That one's garbage. And then the last one says the right mutual fund allows you to beat the market.
That's a bold statement.
I don't know how that you can say that. There's like probably hundreds of thousands of funds in each. And like, you could all of a sudden pick just one growth one and it could beat the S&P 500 in 1 year. You could pick one small cap one and it could beat the S&P 500 over 1 year, but it's not going to continually beat it. And mutual funds aren't going to give you a better chance of doing that than ETFs are, which is why we see a lot of mutual funds converting to ETFs over this time period. I mean, those three baffle me. I saw that and I had to quote them exactly because I was just like, I'm sorry, but those are bad points.
Yeah.
Those are just not selling points.
And then, then that, like, I don't know if you're about to go into the next one, but like when he says that mutual funds allow you to beat the market, when he's saying that the market returns 12% a year and he's saying that mutual funds can beat that out, that's the most insane thing I've ever heard from a financial person.
Yeah. And I think that one's crazy because, again, like when you're doing financial planning, the rate of return you use to project forward for your clients of like, here's how much we need to save to have all of your goals hit, like the number matters tremendously. So if you plan with what Dave Ramsey says is 12% versus the actual average, which is a little bit lower than 10, like you might not think that's a big difference, but it is. And then also if you compound out using these mutual funds that are 1% higher than the ETFs, that also makes a difference. So to use that as an example, if you did $5,000 a year and use Dave's 12% number he uses, that would give you 1.21 million after 30 years. If you use the 10%, which is more of the real average, because his problem is he used the simple average return, but you actually want to use the compound annual growth rate. And that's how he got the numbers mixed up. But that 10% gets you to 833,000. So you're basically looking at about a $400,000 difference, which is 150% more than that $830,000 portfolio is what he says you'll get to when those numbers aren't right. If you need 1.2 million and use the wrong number and you end up closer to that 833, $400,000 of your portfolio is a big difference of what you can live off of in retirement.
100%. Like that's almost like borderline unethical to just like tell people to use that projection. And then you also have to take into account, like, depending on the types of account you're investing in, like there's going to be taxes on the back end, and you kind of have to account for inflation and all sorts of stuff when you're running those numbers. So one, to go with a high unrealistic number of 12% to start with is wrong in my opinion. And then to say that mutual funds can allow you to beat that, like that's just a lot of weird advice going on right there.
Yeah. If mutual funds continually would beat the index, like everybody would be that one. Like you just know it. And that's just
exactly
not how it works.
No one would be buying stocks. No one would be buying crypto. No one would be doing anything except buying whatever this magical Ramsey mutual fund is.
Exactly. Okay. So next one is the debt snowball method is the most efficient. So that's what he says. He teaches everybody to use the debt snowball, which the debt snowball method is basically that you pay off the smallest balance debt you have first. So if you have 5 debts, whichever one is the lowest dollar amount is what you pay first. And the reason why he does this is actually not numerical, it's behavioral. So he believes that if you build momentum and people actually see them pay off this debt and it go away, they're more likely to keep going and and pay off more debt. Great. I think that behavioral point is actually really important, especially for people that maybe only have $50 extra a month. Like it might take them to get that $1,000 a month, or 12 to 24 months. And if they're on the $10,000 one and it takes 10 years, that might really derail them. But for somebody who has higher income, can get out of this debt a little bit quicker, the most efficient way is actually to pay the one with the highest interest first, because it's accumulating the most interest. So financially, you'd be better off doing, that's called the avalanche method of paying highest balance. And some people are highest interest. Some people even do lowest balance, highest interest. So if it's 1,000 at 20% versus 5,000 at 10, you would do that 1,000 at 20% to just get rid of that one quick because it has the highest interest rate.
Yeah. And this is the one that I don't really have too much of a problem with, because then you can really just run the numbers and be like, okay, if I pay off this high interest one, this is how much I'm going to save if I pay it off first. But then the psychological sense of it makes complete sense. Like if you can't like pay off those higher interest ones that also have the higher balance first, like definitely get rid of what you can get rid of and then start working towards everything else.
Yeah, exactly. And then the last one is that he says that basically you should have no debt. And to me, I believe that some debt is okay. Obviously, if you're somebody that can't sleep at night, you hate debt. Like absolutely, maybe you want to avoid debt. For the average person though, that is okay with debt. And you can actually like see it for leverage, see it numerically of like, how it could be better to do that versus saving cash or even sell from investments. I think that's a good thing to do. Like Dave argues that you should have no debt. But again, like with the low interest rate that we're seeing, like right now is a pretty good time to look at leveraging debt. If 3 years from now, interest rates are back to being really high, well, then it might make sense to be avoiding debt at that time. But to me, that's why I'm not paying off my mortgage quicker if I have one, or my car at a low interest rate quicker, because I have locked in this low interest rate that isn't guaranteed and it's not really ever been this low. So I'd rather be able to extend it over that period of time than like, even if I pay off my house quick, I sell it, I go get a new mortgage at a higher interest rate, that's not as good as what I have now.
Yeah, exactly. And I think this one kind of goes back to what I hit on at the beginning. Like he kind of projects his own like personal money beliefs and money values into the advice that he gives, which is completely fine. Like I don't know how you would really go about it a different way.
Yeah.
because like we're talking about it from our own perspective. Like we've only kind of lived in a low interest rate environment and we've never really been bitten by debt before. So we have a little more like just positive emotions towards it. Like it hasn't really been a bad thing to us, and it probably hasn't really been a bad thing to many of our listeners either. So then that kind of allows us to take on maybe a little more risk with debt. And then from Dave's perspective, he's like, I've already gotten bit in the ass once by debt. I'm not going to let my listeners and my followers follow in the same footsteps that I did. So I feel like I would love to hear Dave kind of talk about his own like money psychology and things like that. I don't know if he's ever done it or if he would even be willing to do it. He probably thinks it's bullshit, but that's just kind of, you just kind of have to think about like the perspectives that people are coming from in the advice that they're giving. Like I don't think he means bad when he says like, no, you shouldn't have any debt and anyone who has it is stupid. Like that's just not true. Like it always comes down to your own personal thing. And Dave kind of takes that to another level with his content, I feel like.
Yeah, no, I agree. I just, everything you said was a great summary. The one thing I will add that I didn't add to the thread is that the last one is that what I don't really like is he only recommends to invest in those mutual funds and like really growth orientated. He says you should never invest in like single companies. So like if you have equity comp in your company, I'm sure he probably doesn't necessarily believe in that. Also, no crypto, no individual companies. And like, while I believe index funds are great, like I also don't think 100% of your portfolio needs to be solely in mutual funds or index funds. Like I think investing in some things that you believe in, like he talks about all the behavioral things of momentum with debt, but he doesn't talk about the behavioral side of investing. Like a lot of people want to invest in things they believe in. And sure, you know, the entire stock market, like I believe in the economy is different than, hey, I believe in Nike because I buy Nike and I love it. You know, some people really do need to like get that itch and feel like they're investing in companies and things that they believe in. So I also don't necessarily agree with that viewpoint.
Yeah, no, I completely agree. And I like the idea, I've heard it kind of just thrown around like FinTwit of like you kind of build wealth with conviction and then you preserve it with diversification. So like if you were heavy into crypto for some reason, you know a lot about the stuff and you kind of have seen the trends and you're confident with like your research and your investment things, like the conviction to like go more all in on something could provide you a better chance to build wealth than spreading it out amongst like more I guess like less risky investments and things and just taking a more passive approach. That's
Yeah.
I think that's about all I had to add.
Yeah, that was all the points that I really had. So thanks everybody for tuning back in for another week. We will be back next week. We actually have some pretty exciting guests coming up. We got Carl Richards coming on the podcast, which is a good one. And then hopefully within the next time, we're either going to have the CEO or somebody pretty high up at Trust and Will talk about estate planning. And then we're also going to have the CEO of Rally Road come talk about alternative investments and kind of the things that they're doing at that company. So keep coming back. Yeah, keep trying to add value and talk about different things that relate to your guys' life. So thanks for listening, rate, subscribe, and see you next week.